All right. Good morning, everybody. The bond auction yesterday swung around and got people's attention. It's amazing how that works. We will go months and months without those auctions doing anything to the market. People forget. And then every once in a while, they remind us why we pay attention to those auctions. We have another one today. It'd be the 10-year tips. As usual, it's just something to be mindful of as we come into that time frame. Really can't take a bias on what it will do or not do to the market. Just have to be prepared for the violence if we get any. There's been questions about whether or not we should get long bonds, especially in these lows. Um, you could look around for an interview they just did with Jamie Dimon in the last 24, 48 hours, where he really kind of laid out his thoughts on what's going to happen with bonds and yields. He's not the only one, he's just the latest one to suggest that bonds very likely, stay low for longer, and that we're not yet in that regime to see bonds move higher. I guess it depends on if you're in the camp that says inflation is not done yet and can rear its head again, or if you believe that we're done with higher inflation and that all of this tariff and uh, all the shenanigans of what's been going on, that none of it's going to be inflationary in any way. So you can put your money where your mouth is if you make a decision on one versus the other. We're going to get a little bit of jobs numbers this morning. The Fed has stated that they're done with inflation problems. They slayed that beast and they're worried about jobs, right? That's what they said last year. So jobs of any kind, any jobs data, we want to pay particular attention to that, as that is what the Fed is going to be dealing with. But this isn't the big job numbers, like this isn't non-farm payrolls. Still, any input on jobs, want to pay attention to that. We're going to get some today. So between the job numbers, the auctions, that should cover both the morning and the afternoon. And there was some moves out of Japan in the overnight. Their 10-year, the 10-year JGB is getting violent. And of course, they will tell you right to your face, oh no, we're not intervening in any way. We have no plans to do anything. At the same time that they're pushing the button behind their back to intervene. So Japan said at this point, no, they're not looking to intervene. There's nothing wrong. Let the 10-year JGB go to the moon. They're not going to do anything about it. We've heard that before. We'll see how that plays out. The ES is below the put wall. So looking for the AM edition of the Founders Note to see what they have to say about this, and or what their perspective is on it. I had mentioned earlier in the week keeping my eye on that put wall to see if it gets rolled down or not. That would uh, pave the way for us to go down farther, right? If we're looking for this higher low that I've been talking about to go lower from here, kind of need that put wall out of the way. The concern is when we got to that put wall yesterday, it's supposed to be a spot where we see a reaction in the market, right? They start monetizing their puts. It's supposed to stabilize the market and or even begin to lift us up off of that put wall. Yeah, no, we didn't get that. Right? We cut right through it as if it wasn't there at all. And then buzzbeat off the bottom of it, checking it as if it was a resistance level. So here we are underneath it, resting on the 10-day moving average. And we've got to get back through that put wall or get it moved and have it rolled down. If it rolls down, we can go lower a lot easier. Right? We can go lower anyways, but it will be easier to go lower if the put wall gets rolled down. We are underneath the zero gamma and volatility trigger, but very close to it. If we are trying to define, are we in a negative gamma environment? Slightly, vaguely. Surprisingly enough, it comes and goes, right? It's not a single line in the sand. As we move through the day in these waves, we pass through on a 0-day status, positive and negative gamma structures, right? So in the bigger picture, we could try to define it as a single level, but that's why the heat map on spot gamma, where they call it the trace, that's why trace is a heat map, is because we pass through these zones. If we get 150, 200 points below zero gamma, it's not much of a zone. We're just in, a very negative gamma environment. But right now it's fluctuating. So when we think about a negative gamma environment, it's insight on what dealers would do, how they have to hedge to protect what they're carrying. In negative gamma, they will sell into selling. It's why we would fall farther and faster. And they buy into buying, which is why in bear markets, we get some of the biggest bullish moves we've ever had in history, is because of that. They're buying as we rally. That adds to the buying, and we get those really big rallies in a bear market. If we are in positive gamma and we begin to fall, they'll buy into the fall. And if we begin to run, they'll sell into the run. And that's why in bullish markets, we tend to have smaller, more uniform candles. So right now we're just really close to the line. Those dynamics that I just described really won't come into play with any weight behind it because we're just so close to the zero gamma level. But if we continue to move farther away below that level, then those dynamics that I just described will get more pronounced, more dominant. So it's not just the put wall we want to keep our eye on to see if that gets rolled down, but we want to also keep our eye on where zero gamma is. Overnight volume around 78. It's good. It's within the normal range. So even with, this really swift behavior of yesterday, we didn't see an accelerated amount of trading in the overnight hours. If you remember when things were nasty after Liberation Day and back here late March, early April, the overnight trading was in hundreds of thousands. We're not seeing that participation this morning. I mentioned it yesterday that 5750, hunting around for something cheap to take advantage of a fall of that depth wouldn't be off the table. I'm not expecting it to be that bad, but that's what cheap lottos are for. And if you read the Spot Gamma's Founders Note PM edition, they did mention how cheap the puts are right now. And if you look at TDEX, also that shows that puts are cheap right now, but they are starting to rise. So hedges are cheap. Getting some out of the money options would be relatively cheap, even at this point. Since we're basically flat this morning, we're no closer to one side or the other. It would be easier to hit the upper ADR since that is inside of yesterday's price action, and so are we. But if we, break below yesterday's low, then 58.11 cog line is on the table, and we should get there relatively easy. I wouldn't even focus on the measured move of yesterday's play. Nothing wrong with getting the levels because we would run it level by level all the way down. So there's your 32. Then we get into 22, and then we got the 11 as the cog line. But we should pass through those relatively easy. The 58.13 here, that'll act a bit like a target or a magnet. That would be my shot if we break yesterday's low. Easy enough. The halfback of yesterday lines up really nice with the round number 5,900. It's a big options level and the ADR half. So a really nice magnet to the upside. This seems relatively simple enough. If we get a new high in the Globex, that's your target. So from 75, it's an easy 25 points or so. And if we break yesterday's low, then run the fibs, the 11, the 1, 2, 3, 6, and then the lower ADR. Day done. We go do something else. All right, we are below the week's floor pivot. Yesterday, we would have had an MDP if it wasn't for that little tag right there, but we did tag it, so it's not an MDP. So far this morning, we have one. It's a missed daily pivot. It won't count for today. It'll actually count for tomorrow if we don't run up there and hit that pivot. We have an 80% chance of doing that, which would be a new high on the Globex and would point us towards 58.92 cog line and then 5,900 options level. We may as well, go up and hit the ADR half, yesterday's half, if we begin down that road. It is a wider channel for today, implies that if we attempt to break out of yesterday's range, that it doesn't stick and that we come back in again. That sounds pretty good from the idea that we don't really want to sell off farther. So if the channel is to be believed and we put the fib back on there, if we break out of yesterday's range, that means we would break below 100 there. And that we would come back in again, which is what that wide channel implies. That we could come down, break this, maybe get down into the 1, 2, 3, 6, and then begin working our way back up again. And that's if we get a breakout at all. If we can't get through yesterday's low, then no breakout. It also happens to be that options level that we've been focused on, 58.50. We talked about how there's really not a lot underneath 58.50 until we get to 5,700. It's a 150 point flash crash drop. So if we look at last week, this is kind of the saving grace, what we have right now. After that, things get really shallow. And then we have this gap down through 57. There's nothing here. Now, just because we don't see anything on the volume profile doesn't mean that we would 100% make that fall. There's a lot of other things that we could hit. Moving averages, measured moves. And then there's the idea that the S&P doesn't move on its own, right? There's always something influencing this thing. Bonds, dollar, yield, commodities. So we don't have anything here that we would hit. But out of those other markets or out of the measured moves, there is something that could stop this from dropping all the way down to 57. We just don't have anything on the volume profile. Ten-day, 30-minute volume profile with TPO. Mentioned earlier this week that we could come down and build this level out more. It's the lower value area low. So yeah, the VAH up here. VAL down here. Point of control there. So we're building out the value area low. And you can see the shallow area here. We don't have much. And it doesn't really get better at 57. It's really underneath that. 56.92 cog line. Somewhere above 56.50. So kind of need to keep this. Still not expecting to see the point of control move anytime soon. If we do stay here long enough to bring that point of control down, we're going to hit these candles likely by Monday. So we'll start wiping out the volume that helped build that up. So I still don't expect it to be 58.50 as the new point of control unless we can build out enough volume to replace what we're going to lose and still have enough to bring that point of control down. If we bring it down to 58.50, I'd sure like to be above it when it got there rather than being trapped underneath it. We have a new VPOC added from yesterday. So now we've got two overhead. $59.60 and $59.47. And you can see the really tight distribution we're in down here. If we can get through yesterday's half back and continue that drive to the upside, we've got 59.11 cog line, and then we've got this volume shelf here, this high volume node at 59.32 cog line. We could get through there. It's possible, but then we have the highest amount of volume with the VPOC 59.50, and that's a massive level. It's a lot of structure there. It's really hard to see how we can break out of yesterday's high unless we get some amazing news this morning. And we can hold the line, stop from going deeper, break out of yesterday's low and come back in again as that wide channel implies. But to get a rally, we got to get some juice from somewhere. And right now, we don't have the juice. 2.5% above the 10-week. It's a good place to be. We're still on our way back. There's nothing wrong with anything here. And obviously, we're not overbought. We're not oversold. We're not extended. We're just moving back, trying to heal. And there's nothing wrong with where we are on the 10-week. On the 10-day, well, it's a little hard to see, but there's that nub down there. We are below the 10-day, just barely, but we are below it, and we are driving away from it to the downside. We're not oversold by any means, and there is room to go to the downside before we would even consider the idea that we are oversold in any way. We're at the edge of the week's expected move. 58.50, as we've mentioned before, is the line in the sand that we kind of need to hold. Yesterday's low. The weekly measured move. And below that, we've got this nice gap to fill at 57.59. That's the top of the channel. And the gap would close at 56.78. That's the gap. And the gap would close down there. 56.82. You know, as much as things look negative this morning, we don't have a lot of things that are negative throughout the sectors, just the indexes themselves. And the founder's note came out. Yay. So down the most, solar, nat gas, bonds, China again. And really that's it. Now, if we give a little bit, miners are down. They're not down enough, but they are down. And energy, generically speaking, energy is down as well, just not enough. So if those continue to the downside, they'll reach that 0.5% target. But that's a bit of a surprise. You know, when we look at the S&P threatening a breakdown of yesterday's low, everything looking soggy and weak, we really don't have a lot to the downside. Bitcoin is up. That makes it now 5% in the last 5 days, but it's up 2.25% this morning. The Mag 7 is up some, but not yet enough to meet our qualifications. And the VIX is up. That makes sense, right? The S&P is down, the VIX is up. It's what we would expect. But that's it. So, all right, we got Waller chipping his teeth. If the indexes are doing their own thing minus the stocks, then that discussion of, you know, the S&P running back up and breaking out, the index is turning around and going up, could absolutely happen. We would just need to get the bullish push from the broader market, right? That rising tide that lifts all boats. The problem is the sectors that we have up this morning are pot stocks, commodities, and the Mag 7 group. All right, the Mag 7 has carried us before, right? It did relatively well for 4 or 5 months. And the rest of the market isn't necessarily pushing down against them, so they could carry us this morning. But looking at the S&P, they're not doing it yet. We've got chips in the green, they're just not up enough. Cloud computing, the same thing. It's green, just not much. Those two could really help us out. If we get chips above 0.5%, cloud computing backing it up, even just generically get tech to have our back, we could see the S&P and the NASDAQ begin to push back up. And we're not talking about breaking out of yesterday's high and getting new highs on the week. We're more of just talking about holding the line, maybe getting back above that put wall, because we got nothing else at this point, right? A market that is really concerned about what's going on in the 10-year. We got some moves out of Japan that likely just put gasoline on the fire of all of this. And we need to get into the open, see what we're going to do with it. So at this point, I would say keep your eye on the sectors, because we have a real big discrepancy between the broader market and all of those stocks and the ETFs that represent our sectors and what's going on in the indexes this morning. Gold can be a bit of a tell. Right now, it's basically flat. Yeah. Keep your eye on gold and oil this morning. If we get oil moving back in the other direction and gold starts to sell off, that'll help kind of add some insight into what's going on. Otherwise, you got the levels, and the levels are really clear. Break yesterday's low, begin that expansion to the downside, or break our own Globex high and begin that push to the upside. And as you can see, we're starting the breakdown. So game on. All right, everybody. Be careful, be safe. Have a good day, and I'll see y'all tomorrow.